This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on trading broad bull channels. I want to begin by distinguishing a broad channel from a tight channel. Broad channels have a lot of features of trading ranges, and they often contain trading ranges. And if you're looking at a 5-minute chart, a broad channel sometimes will last for several days. However, no matter how broad it is, if you look at a higher time frame chart, it's usually a tight channel on a higher time frame chart. We have 2 channels here, on the left, on the right, very tight, and this one has deeper pullbacks, and the pullbacks last more bars. It's a broad channel. When a channel is very tight like this, it's very difficult to make money shorting, and you should only buy. You should buy for any reason. You can buy below bars, betting reversals will fail. You can buy strong bear closes, betting bear breakouts will fail. You can buy reversals up from pullbacks. You can buy at the market. Doesn't matter. You have to get long because the odds are the market's going higher. And you can only make money by buying. On the other hand, we have a bull trend, but pullbacks, more bars, they're deeper here, much deeper. And bears can make money fairly easily, both with stop entries and with limit order entries. This particular broad channel is also a wedge top. Because it's still a bull trend, making higher highs and higher lows, bulls can buy for swings or for scalps. However, the pullbacks are deep enough so bears can make money selling for scalps. Bulls will buy, for example, a reversal up from a 50% pullback. Here, a small high 2 buy, high 1, high 2. Here, a bigger high 2 buy, 2 legs down, 1 pullback 2, and both subdivided, 1 pullback 2, and you have a bull bar. Again, a bull channel. And whenever a channel is fairly broad, bulls can buy for swings, but bears can sell for scalps. I talked about this on the last slide. Because it's a bull trend, in general, there's a higher probability to make money if you're looking to buy. Also, in general, the risk reward is better. Whenever you're scalping, your risk reward is never particularly good because you need high probability, and you pay for that high probability with a worse risk reward profile. A broad bull channel has a lot of time in trading ranges. In fact, a lot of times it's hard to tell whether it's a trading range or a broad bull channel. We have a slightly higher low, we have a higher low here, we have a higher high here, another higher high here. So in addition to being in a trading range, it's also in a broad bull channel. Because it's in a trading range, traders can buy low. We're in another trading range here, so bulls will buy low, looking for a reversal up. And bears will sell high, betting that the market will fall far enough for the bears to make money. Here we have a big high 2, 2 legs up, 1 pullback 2, a wedge 1, and then a bear bar, 2, then a bear bar, and then 3 subdivided into a couple legs and then a bear bar. So bears might sell that for a scalp. A micro double top, sell below the outside bar, which would be a second entry short. First entry is below the inside bar here, and it's a failed breakout above this high. Trading range price action. Whenever the market's in a broad bull channel, most of the bars are also in some kind of a trading range. And sometimes the entire channel is just part of a big trading range. Here, you can look at this as consecutive trading ranges, a lower range, and then a breakout, and then an upper range. And here, all of this is a trading range. It turned out it got a bull breakout, but it's still a trading range. In addition to being a broad bull channel with higher lows and higher highs. When the market is in a trading range, it's also often either in a bear trend or in a bull trend. In this particular case, the market is in a trading range, but additionally, it's in a bull trend. It's forming higher lows and higher highs. There's a lot of overlap in the appearance of broad channels and trading ranges, and you trade them very similarly. Trading range, but forming higher lows and higher highs. So even though it's in a trading range, traders are aware that it's forming higher lows and higher highs, and therefore it's also in a bull trend, a broad bull channel. This is a 60-minute chart of the E-mini, and you can see the market is making higher highs and higher lows, and the pullbacks sometimes last 10 bars. It's a broad bull channel, and the insert is a daily chart of what's taking place right here, and the channel is pretty tight. 1 bar pullback, a 2 bar pullback, and the market continues up in a fairly tight channel. When trading, traders should only be looking at about 100 bars on their screen, maybe 150 bars. That means that oftentimes there'll be a broad bull channel on the chart that they're examining, but they won't see it. They'll only see parts of it. For example, if you're only looking at this collection of bars, maybe 70, 80, 100 bars, the market's in a trading range. To see a broad bull channel, you normally have to look at 200 bars or more. Remember, the legs up and down often are 10 or 20 bars long, and you usually need 3 legs before you can conclude that the market's in a broad bull channel. And the result is you usually need at least a couple hundred bars to be able to conclude that the market is in a broad bull channel. But when you're trading, you're only looking at 100 bars. And when you're trading, you should simply trade the 100 bars that are in front of you. It's good to know that the market's in a broad bull channel if you're looking at maybe a collection of bars here, because that'll make you more inclined to buy reversals up. If you're looking at a chart and you're thinking, oh, I'm going to buy here and I'm just going to hold through all of these sell-offs, taking a chance it's a broad bull channel, I would not be managing that trade on the 60-minute chart. I would look at some higher time frame. For example, if you look at the daily chart, these bars are exactly these bars. I would buy here. We have a double bottom and a bull bar, and this is not enough reason to get out. Neither is this, neither is this. So you can swing up. So if you're trading the daily chart, you'd be buying somewhere here, and you would hold through the pullbacks. But if you're going to be trading the 60-minute chart, you're not going to look at this many bars, and you're not really going to be paying attention to the fact that it's in a broad bull channel, and you'll be trading legs up and down, selling when it's going down and buying when it's going up. This is this on a daily chart, and if you're looking simply to buy here or buy here and hold indefinitely and swing it up, I would not trade it that way on the 60-minute chart. On the 60-minute chart, there'll be all kinds of patterns that are taking place and plenty of good reasons to exit longs, and also pretty good reasons to sell as well. And if you're simply looking to buy and hold and trade it like swing trading a broad bull channel, I would not do that based upon the 60-minute chart. However, it's reasonable to do it based upon the daily chart. This is a 240-minute chart, a 4-hour chart of a broad bull channel. A lot of very deep pullbacks. Most of the time, the market is also in a trading range. Many different ways to draw trading ranges. Clearly a trading range here. And because it's a trading range, traders will look to buy low, sell high, and take quick profits, betting that any move down or up is not going to go all that far. And through here, it's in a trading range as well, even though the entire chart ends up as part of a broad bull channel. You don't know that in advance. You know that it's a trading range. You know it has higher lows and higher highs, and it might be in a broad bull channel. And in fact, it is. But traders will often trade it simply as trading ranges. So every leg up and down, they're looking to take fairly quick profits. Some broad bull channels are mostly trading ranges. They're mostly flat like this, and the market has channels like that. Most traders trade them like trading ranges, buy low, sell high, and scalp, and they're less willing to swing. Again, a 240-minute line chart of a broad bull channel. You can see clearly forming higher lows and higher highs, so it's clearly in a channel. The lines are fairly parallel. When I look at a chart like this, I see it as a trading range that's just tilted up slightly. And you can see that that's exactly what it is. If I showed you this chart originally, you'd say it's a trading range. The broader a channel is, the deeper the pullbacks, the more traders trade it like a trading range. 2-hour chart of the E-mini, obviously trending up, higher lows, higher highs, but deep pullbacks along the way. It's a bull trend, so traders obviously want to buy, and a lot of traders will hold part for a swing trade using the most recent major high or low for their stop. However, if it has a lot of characteristics of a broad bull channel, traders will also be looking to sell. Legs up and legs down lasting 5 or more bars. A bull trend, but we have a pullback lasting 5 or more bars, plus it's fairly deep. The legs up and down are at least 3 times bigger than the smallest scalp. The smallest scalp in the E-mini is 1 point, and here we have very deep legs. This pullback is 20 points, many times bigger than a scalp. The legs are several times bigger than an average bar. Here, an average bar is about 8 points tall, and the leg down and the leg up both are more than 3 times the size of that average bar. Sometimes when you have a broad bull channel, the sell-off will be so strong, traders will see the market as always in short. Very common in a broad bull channel to have some sell-offs that are strong enough to make traders believe that the market is always in short. Pullbacks often fall more than 50% below the top of the bull leg, and sometimes they retrace 90%. Here we have a micro double bottom, and it's above the bottom of the bull leg, and therefore it's possibly a higher low in a bull channel. This pullback is 52% of the most recent bull leg. Bulls and bears can make money with stops. If a channel is fairly tight, it's very difficult for bears to make money selling with stops. However, when the channel is fairly broad, you can see that stop entry bears can make money, and that is a sign that a channel is fairly broad. I want to talk a little bit more about how broad channels contain trading ranges. 2-hour chart of the E-mini. Here's the breakout point. The rally broke above that high, and this is the pullback. There is a lot of overlap between the pullback and the breakout point, and that means bears can make money. And you look at every breakout point. We have another breakout, and the pullback falls below the breakout point. Another breakout here above this high, and the pullback fell below the breakout point. We have a gap here, but ultimately it closed over there. When there are no gaps, or very few gaps, it means that the bears can make money selling above prior highs and scaling in, betting that there'll soon be a reversal back below their original entry price, and that will allow them to get out break even on their first short and with a profit on their higher short. They sell, hoping the market immediately turns down. However, they're confident that if instead of going down it goes up, they can sell more and it will eventually fall below their first price, and they can get out, break even on their first, and with a profit on their higher short. Some traders, instead of selling with limit orders at the prior high, will wait for the breakout to new high and then sell below a bear bar, especially if there's a climax or some kind of a micro double top, up, pause, top, double top here, and we have a small double top here, double top here. Broad bull channels often have trading ranges separated by occasional breakouts that can be big, and they can lead to measured moves. Here we have a lower trading range and part of a broad bull channel. We have a breakout and a pullback, and the pullback stayed above the breakout point. We have a gap, so it might result in a measured move up. Here's the size of the bear leg. A measured move up from the top of the bear leg took us right here, and you can see there's some profit taking there. We have a trading range, a strong bull breakout that just lasted one bar, and then another trading range. So we have trending trading ranges. 60% of the time, if you have trending trading ranges, a trading range, a brief breakout, and then another trading range, 60% of the time, you'll get a reversal below the bottom of the upper range and at least a little into the top of the lower range. And that means the bears who sold the breakout 60% of the time can get out avoiding a loss, and if they scale in higher, they'll make a profit on their second entry. 5-minute chart of the E-mini. Whenever you have a broad bull channel on a 5-minute chart, in other words, one lasting within a day, usually you end up with some kind of a wedge top. Usually it has 3 pushes up, 1, pullback 2, pullback 3. When traders see that third top, they start thinking that the bull channel is a wedge, and they look for a couple legs down, especially when the trend began with a spike up, a strong breakout. So you end up with a spike in channel trend. A breakout, first push up here or here, a pullback, second push up, pullback. Traders look to sell the third push up, expecting a deeper pullback, maybe all the way down to the bottom of the channel, the beginning of the channel. We have a bull breakout and a pullback, more of a pullback here. When the market reverses, it often gets down to the start of the channel. Fairly broad bull channel, pullback lasting 5 or 10 bars, lasting 10 bars, lasting 5 or 10 bars. Now, the bulls who are buying, usually when they see the third leg up, they become hesitant to buy a fourth leg up because they know that it's more likely the market is either going to be in a trading range or have a couple legs down. And by the end of the day, especially when you're getting a lot of dojis, the market probably does not have enough time to get trend resumption up. What often happens in a broad bull channel on a 5-minute chart is by the time traders believe it's a broad bull channel, there's not much time left in the day and there's not much left to the trend. We have a wedge top, testing the top of the channel, first reversal down. We tried to resume up above this bar, and now we have a second reversal down, and this time with a bear bar. It's a reasonable stop entry short, maybe for a test all the way down here. However, what ended up happening was the market went mostly sideways. Again, whenever you have a fairly broad channel on a 5-minute chart, it usually is going to form a wedge top or a trending trading range day, a series of trading ranges, 2 or 3 trading ranges. We clearly have a broad bull channel. You don't really know that for sure until the end of the day. We have higher lows and higher highs, and the pullback lasted 20 bars, fairly deep. This went down about 10 bars, overall sideways for about 20 bars. However, most traders looking at a day like this would say, we had an opening trading range, a brief breakout, and then an upper range, so a trending trading range day, and the market failed to break back below the top of the lower range. So you can see these lows are exactly at that high at the top of the range, and the bull's got a micro double bottom. That makes it likely that instead of testing below the top of the lower range, we're going to get a reversal up and test the top of the upper range. And here we ended up breaking above the top of the range at the end of the day. Because it's a trending trading range day, it's mostly a trading range. We have a lower range, a brief breakout, and an upper range. And therefore, traders tend to trade it in both directions. When you have that breakout, chances are you're going to get a second leg up. It's easier to make money looking to buy. So you buy reversals up from pullbacks. However, we got a micro double top. It looks like a trending trading range. We have a lower range, and then we have a breakout that's brief, and then we have a lot of trading range trading. Therefore, this is probably a bull leg in a trading range, and traders will look to sell a second reversal down, not expecting a bear trend, but expecting a scalp. You buy low, sell high, and scalp. Now we're reversing up, micro double bottom, test of the top of the lower range, going higher, and now a very tight bull channel. It looks like it might be by the close for the end of the day. Again, by the time traders start to view this as a broad bull channel instead of a trending trading range day, there are not that many bars left to the day. So all through here, I would call this a trending trading range day, a lower range, a brief breakout, and an upper range. However, at this point, you look at it and you say, oh, we have another new high. Maybe in addition to it, a trending trading range day, it's also a broad bull channel. There's very little time left to make much money here. You get one more scalp up. I said that when you have a broad channel on a 5-minute chart, the channel often lasts 2 or 3 days. This is a 5-minute chart, and I have a bar chart so that I can show many days, and this is actually 3 days at this point. We have a bull trend, a trading range, we're getting trend resumption up, and now we're getting a reversal down. Now, 5-minute charts usually do not have obvious broad bull channels. One of the reasons for that is you need a lot of bars to know that the channel is broad, sometimes 100 or more bars. There are only 81 bars in the day session of the E-mini, and that's often not enough bars for you to see the broad bull channel. I'm using this bar chart to allow me to put a lot of bars on the chart. Again, this is 3 days, so it's 243 bars. It may not look like it, but it is. At this point, we have a bear channel, and you can call it an upper trading range, although we have not rallied up and we have not sold off again. So we're not sure that it's an upper trading range, but it might be. It could be a small spike, pullback channel, test of the beginning of the channel. It looks like it might be forming a trading range. Big up, big down, big confusion, and sideways. It's also possible that it's a higher low and what will end up as a broad bull channel. We're getting higher highs through here. We're getting higher lows and possibly another higher low. Very often, when you look at a chart, it has a bull trend, a bear trend, and a trading range all at the same time, and you don't know which one will end up taking control. We're clearly in a bull trend, and we're possibly in a broad bull channel, with this being simply a higher low and a broad bull channel. And we're obviously in a bear trend, and we don't know if it'll continue all the way down. And this is what followed over the next week or so, actually a couple of weeks. We have another high, a new low, and then another high after that. And therefore, even though it was in a trading range and in a bear trend, all of that was part of a large broad bull channel. Remember, a broad bull channel has legs that last a lot of bars, 5 bars, 10 bars, sometimes 20 or 30 bars. Here, this leg lasted, I don't know what that is, 50 or 60 bars. And it's hard to see it as a channel if you're just trading the 5-minute chart, unless you put up a bar chart that shows a lot of days. It does not matter. If you're a day trader trading the 5-minute chart, you do not need to know that this bear trend is part of a broad bull channel. You're going to trade it like a fairly tight bear channel and look mostly to short, even though it ended up as a bear leg in what is a large broad bull channel. It's very common that if you look at a lot more days, a higher time frame chart, it can be a trend in one direction, yet there can be very strong trends in the opposite direction within that trend. And these bear trends, these bear channels, end up as bull flags, leading to trend resumption up. Broad channels are much more common on higher time frame charts than they are on 5-minute charts. For example, 60-minute charts, daily, weekly, and monthly charts. Again, as I said, on a 5-minute chart, it often takes several days before you see the broad bull channel. Also, broad bull channels often have periods when the market is actually always in short. A bear trend here for a day and a half, a bear trend here. If you're trading a 5-minute chart, you trade the chart that is in front of you. And if you were trading a 5-minute chart here, you would not be looking at this. You would simply be seeing this and you'd concentrate on getting short. Very strong breakout, and we have a higher low pullback. So a higher low, major trend reversal. Even though it's only one bar up, it's so exceptionally big that it's enough to make traders to look to buy a higher low. Here we have a higher low, major trend reversal. We have a bull trend, a bear breakout, and a double top lower high. Traders will look to sell. We have a bull trend, a bear breakout lasting a lot of bars, and then a higher high with 4 pushes up, so a type of wedge top above this high. Traders will look to sell that as well. This is a broad bull channel lasting about 6 days. If you like to trade patterns that last 3, 4, or 5 days, it's probably better not to be looking at a 5-minute chart. It's better to be looking at a higher time frame chart, like a 60-minute chart. When you see a broad bull channel on the chart in front of you, for example, if you're a day trader looking at a 5-minute chart, if you look at a high enough time frame chart, that broad bull channel is usually a fairly tight channel. Let's take a look at this. We have a deep pullback here, 10-bar pullback here. So this bull leg, even though it might be part of a bigger broad bull channel, it's a fairly broad channel here, especially given this pullback. Traders will buy the reversal up from the double bottom. They'll buy the breakout. After each strong breakout to a new high, they'll trail the stop below the most recent major lower high. Here we have a gap up and a rally to a new high, 2 bull bars. Therefore, this is a major lower high. Bulls who are long or who bought up here will have a stop down here. Traders will hold long until there's a clear opposite signal or until their stop gets hit, betting that the channel up will continue for a lot more bars. I talked about distinguishing a broad bull channel from a tight bull channel. I trade them differently. A tight channel, it's usually better only to buy. If you have a broad bull channel, it's always good to be buying for a swing or for scalps. However, if the legs down are strong enough and last enough bars, you can also make money selling. Since it's a bull trend, usually it's better only to be scalping if you're selling against the trend. Broad bull channels are often indistinguishable from trading ranges. Much of the chart is going to be also in a trading range. And broad bull channels on a 5-minute chart often last several days. However, they're still often fairly tight channels on a higher time frame chart. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on trading broad bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading broad bull channels. I want to talk a little bit about major and minor lows inside of broad bull channels. And an important point about a broad bull channel is it sometimes has bear legs that are strong enough to make the market always in short, yet those bear legs are still within a broad bull channel. This is several days of a 5-minute chart, and you can see the market is working higher, and it has strong sell-offs along the way, yet every low led to a new high. This is a broad bull channel, even though it's not easy to see the channel. We're making new highs, new lows, higher lows. This low fell below some of these lows, but formed a double bottom with this one, and we went strongly to a new high. It's a bull trend, and you have to call it something. It's not a strong breakout. It's not a tight channel, and that leaves you with a broad bull channel. We have a strong rally up to a new high, and once you have this strong rally to the new high, this low becomes important. I would call it a major low. If a pullback falls below this low, once you have a rally like this, if the market reverses down below this low, I would say it's no longer in a bull trend. Right now, this rally is, at this point, either in a bull trend, which it was, or possibly in a trading range. If we get a reversal down that falls below a major low, then it's no longer in a bull trend. It's then either in a bear trend or a trading range. So I pay attention, if the market is trending up, to major higher lows. Minor higher lows like that or like this are not important, but the major higher lows are important. The market sold off strongly and then rallied in a pretty tight channel to a new high. At this point, you know this is a major higher low. And the same here. We gapped down, but we rallied up in a fairly tight channel to a new high, and therefore this higher low is major as well. Here, the market collapsed on the open after a small gap down, yet it had an opening reversal up, and somewhere in here, once you're above these highs, you'd have to conclude that this is a major higher low in a broad bull trend. Even though the market here fell below these prior major higher lows, and at that point, the market is not in a bull trend, it's either in a bear trend or a trading range. It reversed up strongly, and at some point, when it starts to break above these lower highs, you have to conclude that the market is no longer in a bear trend or a trading range. It's back to being in a bull trend or a trading range. Remember, I said bull trend or a trading range. We have a major higher low here. Market's in a bull trend or a trading range. If it falls below this low, then it's either in a bear trend or a trading range. Now, it could still be in a trading range, and if it's in a trading range, it often falls below the low and then reverses up, which it did. But it's not back to a bull trend until it breaks above a major lower high. Major lower high, we have a lower high, and it broke to a new low below major lows. So it went back to a bull trend here. So at this point, when it starts to break above these highs, it's back to either a bull trend or a trading range. Again, major higher lows means a bull trend or a trading range. This low fell below these other major lows, and therefore bear trend or a trading range, but then we broke above a major lower high and a major high here, so it's back to a bull trend or a trading range. These are major higher lows. These are minor higher lows. Do not lead to strong breakouts, even though they led to new highs. And some of them don't even lead to new highs. For example, here's a higher low, did not even lead to a new high, so a minor higher low. We have a low and we have a breakout, but it's not particularly strong, even though it's a new high. I would call that a minor higher low. and I would look to the left to find the most recent major higher low, which is right here. Here we have a reversal up, did not get to a new high, and the reversal up was brief, so I would call that minor as well. Here we have a reversal up, and it reversed back down. Here we reversed up, not all that big, and it's at the top of the trading range. I think it's a fairly minor higher low, and therefore if we fall below it, we still could be in a bull trend. Whenever the market falls below a minor higher low, bulls buy the reversal up, betting that the bull trend will continue. The odds of the market becoming a bear trend after breaking below a minor higher low are small. More likely, the sell-off is a bear leg in a developing trading range. We have a very tight channel. We have a lot of higher lows. They're all minor. And if the market reverses from a tight bull channel, the reversal is probably minor, a bear leg in a trading range or a bull flag. I mentioned this one earlier, that a very strong breakout below a major higher low here and below a major higher low here and below all these minor higher lows. So at that instant, the market was either in a bear trend or a trading range. If it's in a trading range and it reverses up, traders will buy it because they're buying the bottom of a trading range. Here we have a possible slightly lower low, double bottom. What caused this sell-off? It probably was simply a sell vacuum test of support below major higher lows, and especially this one, the bottom of a trading range. And the bulls bought it. Therefore, we had a double bottom. When you get a breakout, traders will look for a measured move up. I mentioned that even if you're in a bull trend, there can be times when the market is actually always in short. Some of the legs down in a broad bull channel are strong, and the market can be always in short, which means the market's likely to go lower, not necessarily reverse into a major bear trend, but the bear leg still could go lower and be part of a broad bull channel. There are many days here. I don't know how many days there are, 5 or 10 days. I trade each day separately, and that means some of the days can be bear trend days, even though the overall trend on the chart that you see here is still bullish. This is a trading range, so traders look to buy low, sell high, and take quick profits. And the same here. These are still trading ranges within a broad bull channel. When a market's in a broad bull channel, it usually is also in a trading range for a lot of the time. And sometimes it's even in brief bear trends. When the market's going up, obviously bulls are buying, betting on trend resumption up. And sometimes the swings down last 10 bars, 20 bars, 30 bars, and the market can even be always in short, which means traders will sell, expecting it to go at least lower enough so they can make a profit by selling, even though overall we're still in a broad bull channel. Here are the days on that chart that I showed you, and taking them one day at a time, and you can see there's a lot of variety. We have a bull reversal in the open. We sold off a little bit, reversed up, and now we have a high 2 or a wedge bull flag, and now we're resuming up. Traders are buying on the way up, and it became a very tight bull channel. And they traded it like a tight bull channel. They bought for any reason. They bought below bars, betting the reversals down will fail. This is more of a trading range day. Traders bought for scalps, they sold for scalps. And here we have a strong bear breakout below the bottom of the range. And whenever you have a strong bear breakout in a trading range day, you always have to be thinking it might be a second leg trap. And instead of a breakout leading to a trend down, it could be a breakout leading to a reversal up. First leg down was a high 2 bull flag, and second leg down was a strong bear breakout that failed. Again, a tight bull channel, and the bulls bought for any reason at the market, above bull bars, below bull bars. another reversal up, 2 legs down. Traders will buy the reversal up, they'll buy closes at the follow-through bar. We have a bull flag, they'll buy a breakout above the bull flag. Here, a small high 2 bull flag. We went down, we went up, we went down again, and we're resuming up. Tight trading range. Most traders should not trade it, but limit order traders will scalp. They'll buy low, sell high, and scalp. A broad bull channel. We have a high, a higher low, another higher low. It's also a trading range for most of the day. So traders will buy low, sell high, possibly swing longs, and definitely the bears will scalp. Broad bull channel, traders buy low, they sell high, and they take relatively quick profits. Remember, a broad bull channel has higher highs and higher lows, but oftentimes it's mostly sideways, so traders trade it like a trading range. A very tight bull channel, a strong breakout, traders buy closes, they buy at the market, they buy below bars, they buy bull flags, and then enter the trading range. Big up, big down, big confusion, so probably sideways. Traders will buy low, sell high, and scalp. Small pullback bull trend day, very strong sell-off, sell to close sell-off on the open, and then we got a micro double bottom and a reversal up and a strong breakout, and then we had a small pullback bull trend. Again, in a small pullback bull trend, traders are only going to buy. When you look at any one of these days, it's hard to tell simply looking at the day that it's part of a broad bull channel. That's because a lot of times you can only see a broad bull channel if you look at a lot of bars, 100 or 200 bars. If you're looking at a 5-minute chart on the screen, typically you're looking at about 100 bars. And most of the time, broad bull channels are not clear unless you look at several days of trading and not just one day of trading. Or you can look at a higher time frame chart. A higher time frame chart, a broad bull channel on the 5-minute chart is probably going to be a relatively tight channel on the 15-minute or 60-minute chart. But in either case, it'll be a bull trend. Most day traders are aware that the market is trending up for the past several days in a broad bull channel. However, they trade each day as it unfolds, and that means sometimes you'll have a bear swing and they'll trade it short, even though the past 2 or 3 days might be in a bull trend. If you do see that the market is trending up for 3, 4, 5 days, then you look at the 5-minute chart today, it's better to focus on buy setups because the odds are the trend of the past 3, 4, or 5 days will continue today as well. And that means it'll be easier to make money buying if the market's in a bull trend. 9 days in a broad bull channel. Again, if you're looking at a 5-minute chart and you're a day trader, you're not going to be paying much attention to these 9 days. And therefore, you may not be aware that today is actually part of a 9-day broad bull channel. If you're a day trader, you're looking at today and you'll be placing your day trades based upon the 100 bars that you have on the screen in front of you, not paying a lot of attention to the 200 or 300 bars to the left. If you do look at more days, for example, if you put up a bar chart and compress the bars so that you can see many hundred bars on the chart, you can see that it's a broad bull channel. However, you can do it faster by simply looking at a 60-minute chart or a 15-minute chart. As I said, if you want, you can trade it on a higher time frame chart. Whether you're looking at a 5-minute chart or a 15-minute chart, you can tell that the market is forming higher highs, higher lows, and is working higher. And therefore, every time there's a sell-off, you'll bet the bear reversal will fail and you'll buy a reversal up. The result is you're buying a pullback, buying a pullback, buying a pullback, 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 pullback. You're betting that the bear reversal will fail, so you buy the reversal up. And that's what you always do in a bull trend. You're always betting that bear reversals will fail, so you look for them to fail and you buy the reversal up. Some traders who trade higher time frame charts, like a 15-minute chart or a 60-minute chart, will look at a smaller time frame chart for a slightly earlier entry. For example, if you were looking at a 60-minute chart or a 15-minute chart, you'd see the bull trend and you'd see the reversal down. You'd bet it will fail, and you'll put up a 5-minute chart to enter above a 5-minute bar, the same with here or here, instead of waiting to enter above a 60-minute bar, which probably would be a much higher price. Here's a 15-minute chart of that same broad bull channel that I've been showing on the 5-minute chart. Here, it's a trading range. It's a trading range within a broad bull channel, but it's a trading range. And you can trade it like a trading range. You look to buy low, sell high, and scalp, betting that every leg up and down is more likely to continue sideways than become part of a new trend. It's obviously also in a bull trend, and you can trade it like a broad bull channel, buy low, use an appropriate stop, and then just hold for a swing until it's no longer in a bull channel. You can buy, use an appropriate stop, and hold overnight until you either have your profit target met or you think it's no longer in a bull trend. Or you could simply buy every day and then get out at the close. Buy, get out at the end of the day. Buy, get out at the end of the day. Buy, get out at the end of the day. Or you could simply exit on a reversal down. You buy, and it's not quite the end of the day, but you're near the top of the trading range and it's starting to reverse down. Here's a 60-minute chart, the same 9-day stretch, but this time it's a 60-minute chart. And the channel is fairly tight. Pullbacks are only lasting a few bars, mostly sideways. And when the market is in a fairly tight channel, it's very difficult to make money selling. If you're trading those 9 days on a 60-minute chart, you're only going to be buying. You get a breakout bar and a bull close, you buy the close, and you got more follow through here. You have a bull flag, a high one bull flag, you buy above the high of that bar, and the same here. Here you get a bull breakout, strong close, you buy above this bar, a pullback, or you can buy the closes. Here you get a reversal down, you have a double bottom bull flag, slightly lower low, but double bottom, and a 2-bar reversal. You buy in a stop above the reversal. You buy a breakout, or you buy the close of the follow through bar. Here you get a triangle, 3 pushes down, 1 and then bull bar, 2 and then bull bar, and then 3. You could buy the breakout there. In any case, the important point is on the 60-minute chart, it's a tight channel, even though it's a broad channel on the 5 and 15-minute charts. If you're trading the 60-minute chart, you're only going to be buying because the channel is tight. After each strong breakout to a new high, you then know this is a major lower high, and you raise your stop to just below the bottom of the major leg up. It doesn't matter whether you bought here. Once you see this, your stop goes here. If you bought here and you're still holding long, and now the market's up here, the stop goes here. You got to trail your stop up after each strong breakout to a new high. The market's in a trading range here and not a tight channel. You can trade it like a trading range. However, the range is so tight and it's following a bull trend, you're more likely to get trend resumption up than trend reversal down. So a lot of traders would concentrate on only taking the buys and not take the shorts until there's a clear, strong, major trend reversal. This is a lower high, a double top, but I'm not sure that there's enough selling pressure to make this a worthwhile sell, betting it's a slightly higher high major trend reversal. Too many big bull bars, not enough bear bars. The reversal down probably will fail. When you got a breakout like this, you broke below that low and you reversed up and you have a good 2-bar reversal. You got 2 legs down, 1 pullback 2. Let's say you buy on a stop above this bull bar. It's okay to use a stop here, because if this is a resumption of the bull trend, and it probably is, it should not fall below this low, below this double bottom, and therefore some traders would use a tight stop even before the strong breakout. These traders buying here, as soon as they enter, would put their stop here instead of down here. They could use the wider stop, but if this reversal is good, it should not fall below this double bottom, and therefore it's okay to use the tight stop even as soon as the market trades above that bull bar instead of waiting for a strong breakout to a new high. Breakout, you only want to buy. Tight channel, you only want to buy. I talked a little bit about major and minor lows. If you have a major reversal down, you're expecting an opposite trend or possibly a trading range. If you have a minor reversal down, you're expecting a bull flag or a trading range. Most traders will not exit if the market falls below a minor low, because the odds are there'll be buyers below. On the other hand, if it falls below a major low and a bull trend, then it's no longer a bull trend on that chart, on the chart in front of you. It might still be a bull trend on a higher time frame chart, but the chart you're looking at is no longer a bull trend. It's now either a bear trend or a trading range. Sometimes in a broad bull channel, you can get legs down that last a lot of bars. And if you're looking at a broad bull channel that has several hundred bars in it, you can often get 30, 40, or 50 bars in a bear swing. In other words, a swing down that lasts several hours. And the market can even be always in short, which means if you sell, you believe it's going at least a little bit lower. Yet, the bear reversal will fail and the bull trend will resume. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading broad bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bull channels. Like a channel, you expect reversals to be common, but because it's a bull trend, you have to assume that most of the reversals will fail. It's always better if you can diagnose the broad bull channel early. That way there, it allows you for an earlier entry on your swing trade. Because the sell-offs tend to be deep, bears can make money by selling rallies, for example, reversals down from new highs. Also, you have to expect that the follow-through after a new high is going to be bad. The bears are selling up there, and the bulls are selling to take profits. This is a 5-minute chart showing 9 days of the E-mini, and the market is trending up, lower left, upper right, and lots of pullbacks, and some of them are pretty deep. Therefore, it's a broad bull channel. Here, the market went sideways for about 2 days, 150 bars in a tight range. And that's common when the market's in a broad bull channel. It usually has extended periods where it's sideways. For example, here, and then again here, and then again here. Also, it's common for the market to have very strong sell-offs and at times become always in short. Strong sell-off here, here, protracted sell-off here, and then a very strong bear breakout here below the bottom of the entire 150 bar range. The market's always in short during this sell-off. However, because it's a broad bull channel, unless it breaks strongly below all the lows, including this low, it's still in a trading range as well as a broad bull channel. At this point, once it breaks below here, it's clearly in a trading range. When it breaks below a major higher low like that, it's also in a bear trend. It may quickly resume back into a bull trend, but at that instant, when it broke below all of these lows, it's in a bear trend and a trading range. Once it starts to reverse up strongly, it's then back to a bull trend and a trading range. Whether it's in a trading range or a broad bull channel, traders are going to be buying reversals up from near the bottom of the range, especially reversals up from breakouts below prior major lows. As I said, sell-offs are common. Sometimes they last a lot of bars, and they can often reverse the market to always in short. For example, here, clearly the market was always in short somewhere in the middle of this bar. As long as the market's making a series of major higher lows, the bulls are going to assume that all the reversal attempts will fail, even if the market becomes always in short. When it's always in short here, it's likely to go lower, but unless it breaks strongly below the bottom of the range, a reversal up is more likely than a continued trend down. Bulls buy reversals up from all sell-offs. Sell-off reversing up. Sell-off, they buy the reversal up. They buy the reversal up all day long, every day. They expect the reversals down to fail and for the bull trend to resume. All trends are constantly trying to reverse. That's especially true in broad channels. Here we have a broad bull channel, and at every high, bulls take profits because they think it might be a trading range instead of a broad bull channel. They want the broad bull channel to continue, but they know that much of the time the market's in a trading range, for example here, and therefore they tend to take profits at the prior high or above the prior high, and then look to buy again lower. However, it's a trend. It's a weak trend. A broad bull channel is a weak bull trend, but it's a trend, and therefore the odds are the tops are going to fail. Markets have inertia. They tend to continue to do what they've been doing, and if the market's in a bull trend, it'll tend to continue to be in a bull trend. Traders are always seeing tops, and the tops are real. We have a bull trend, a bear breakout, higher high, major trend reversal. It failed, and now we have 3 pushes up, 1, 2, 3, a wedge top. However, all of the reversals fail, and the market continues to make major higher lows. Higher high, major trend reversal, wedge top, and now we have a big double top. The market broke below the neckline, and what happened? The bear breakout failed, and the market reversed up. Expanding triangle, we have a high, a higher high, and a higher high. Yet the expanding triangle top failed, and we got a double bottom bull flag. Lots of double tops. There's one here, one here, one here, an attempt at one here, a double top lower high here, a double top attempt here. It doesn't matter. We have another one here, another one here. If you want, you can call this one a wedge. Because it's a bull trend, you have to assume that all of these tops are going to fail and the bull trend will continue. Markets resist change. And because of that, every time the bears do get a reversal, even if it's strong, bulls expect it to fail and they buy a reversal up. Or they simply hold long and use a very wide stop. As I said, broad bull channels contain trading ranges, and therefore a lot of the bars in a broad bull trend are also in a trading range. Whenever the market falls below a higher low or below a trend line, it might begin to enter a trading range. The bears are hoping that the break below the trend line will lead to a major trend reversal top, but more likely a trading range. Whenever the market's in a trading range, there are always both buy setups and sell setups, and both are reasonable. The market keeps breaking below trend lines, and you redraw the trend line on the next reversal up. The trend lines get flatter, and the channel gets flatter and broader. Every time you get a new reversal up, you have a new low that you can use to draw a channel. And you can see the lines are getting flatter, and the channel is getting flatter and broader. If I had a line drawn across the top of the channel, the distance between the top of the channel to the bottom of the channel is getting greater as we continue to draw flatter and flatter trend lines. Initially, we had a very tight channel, and by this point, we have a very broad channel. This was a steep channel, and this is a much flatter channel. That's the natural history of a bull trend, and eventually it evolves into a trading range, and then at some point it reverses into a bear trend. Remember, the market's in a bull trend. At some point, it transitions into a trading range. The bulls want trend resumption up, the bears want trend reversal down. But as long as it doesn't reverse into a bear trend, traders will buy breakouts. They'll buy breakouts below prior lows. Here we broke below a low, they buy the reversal up. Broke below this low, buy the reversal up. Broke below this low and below that low, they'll buy the reversal up, betting that the market will either remain in a trading range or the bull trend will resume. Very strong bear breakout. At some point in here, the market's always in short, meaning the market will probably go lower. However, once it gets down to the bottom of the trading range, the most important major higher low to the left, the bears need the sell-off to continue. And if instead it stalls and reverses up, traders will assume that the bears will buy back their shorts and the bulls will buy, either for resumption of the trading range or a resumption of the bull trend. Trading ranges often have very strong second legs down. For example, leg 1 and then an even stronger leg 2. Leg 1 and then an even stronger leg 2. I call that a second leg trap. It traps traders into thinking that the bears have won and that we've begun a bear trend and that this breakout is going to be the start of a protracted bear trend, but instead it simply traps weak traders into selling near the low. Second leg traps, common in trading ranges, also common in broad bull channels. Every bull trend needs a series of higher lows, especially major higher lows. Major higher low is a higher low that is relatively strong and breaks to a new high, usually breaks to a new high. As long as it's forming major higher lows, it's in a bull trend or a trading range. If it breaks below major higher lows, then it's no longer in a bull trend. It's then either in a bear trend or a trading range. If it reverses up strongly, at some point it goes back to being a bull trend. As long as any of these reversals stay above this low, the bulls still might be in a broad bull channel. In other words, we could have a sell-off all the way down here and then up to a new high, another very deep sell-off, another new high, and it still would be in a broad bull channel. A very broad one, but still a broad bull channel. I mentioned that it's helpful to your bottom line if you can diagnose what is going on as early as possible, and that allows you to trade it appropriately as early as possible. Whenever I look at a chart, I'm always wondering, where are we in the market cycle? Are we in a breakout? Are we in a reversal? Are we in a channel? Are we in a trading range? Sometimes we're in several things. Market's going sideways, and then we have 3 consecutive bull bars, 2 of them big, closing on their highs, breaking above this lower high. The market is clearly always in long. And as long as the market stays above the bottom of the bull trend here, then the odds are any sell-off will be either simply a bear leg in a trading range or a bull flag leading to higher prices. Sometimes broad bull channels become always in short. Here we have a breakout to a new high, and then we get a series of bear bars. At this point, we have 3 bear bars with decent bodies, 4 bear bars if you count this one. Is the market always in short? Well, it's more likely to go a little bit lower, but not necessarily below the bottom of the bull trend. So in that sense, it's always in short because we're probably going a little bit lower. For me, it's probably big up, big down, which means big confusion, and the market will probably go sideways for a little while before the bulls try to resume up. A good bull bar, we have a bear bar, and now we have a reversal up. We have the bull breakout. This is testing the bottom of the bull breakout, which is common, and it's a higher low. If the bulls did exit their long after 3 or 4 bear bars, they'll look to buy again above a strong bull bar, for example, above the high of this bar, just in case the bull trend resumes up. They know the downside risk is not that great. Big up, big down, probably sideways. Unless we break below this low, the bulls will assume that the best the bears get is a bear leg in a trading range, which means it'll be followed by a bull leg in the trading range or by a resumption of the bull trend. And therefore, bulls are willing to buy a reversal up. Trading range with lower highs, higher lows, it's a triangle. Broad bull channels often spend a lot of time going sideways, and this is an example. It's sideways here for about 40 bars, and now we're at the apex of a triangle. But it's still forming higher lows here, here, and here, even though it's not forming higher highs here. This is not a higher high, this is not a higher high, and neither is that. Another strong breakout, a pause, and a small second leg up. And now we have 3 consecutive bear bars. 2 decent-sized bodies, this one fairly big, closing on its low. Triangles are often final bull flags, which means the market often pulls back to the apex of that flag. A lot of bulls will get out if they see a breakout, a small second leg up, and then 3 bear bars breaking out of a triangle. Is it always in short with these 3 bear bars? Probably not, but it's enough of a pullback after a buy climax so that the market might go sideways. How do you know that the market's in a broad bull channel? You usually need at least 3 legs up. So 1, pullback, 2, pullback, 3. So at this point, it's in a bull channel. But usually when you get the 3 legs up, it's also in a wedge, and that could lead to a reversal. Different ways to count it. 1, 2, 3. Or you can view this as a double top and then a breakout above a double top. If the market has a double top, it has 2 legs up, 1, pullback, 2. If it breaks above the double top and reverses, that is a type of wedge top, even though it does not look like a wedge. It functions like a wedge. So a breakout above a double top that fails is the same as a wedge top. Some traders would sell the reversal down. We have a breakout, a pause, a smaller bar, and a second leg up. We have a potential final flag and different ways to draw a wedge. Bear bar closing on its low. At a minimum, traders would expect a couple legs down, maybe a test of the apex of the triangle. It's okay to sell the reversal down, not clearly always in short yet, sideways more likely than down, although here it ultimately went down. Bears will sell below bear bars. They'll sell here. We have an II, a small triangle. They'll sell the breakout, and they'll sell above bars as well, above this bar or above the top of the sell climax. And then another low too short, 2 legs up, 1 pullback 2. Another reason to go short. A lot of times you look at a chart and you're not sure if it's a broad bull channel, if it's a trading range, if it's a wedge. What you do is you simply trade what is clear, and a lot of times you don't fully get confident about which pattern is dominant until well into the pattern. We have a double bottom, and we have a bear breakout below the double bottom, but it failed twice. We bounced here, and we bounced again here. And the bull bars here are closing near their high, probably going higher. We have a good-looking bull bar here, and a second buy signal bar here. It's reasonable to buy on a stop just above the high of that bar. Consecutive bull bars breaking out, strong, closing on their highs, big bodies, traders will buy that close. High probability of follow-through buying. The market's always in long. Well, the bears, they see two reversals down, one pullback, two, and they'll short this, especially since it's a type of second leg up. We have a pair of strong bull bars, a smaller bull bar, and then a bigger bull bar again, so that's a second leg up. This is not a major reversal. Traders selling here are looking for a scalp. After 5 consecutive bull bars and 4 of the bull bars closing on their highs, the reversal is probably minor, but given that it's a low 2 and we have 2 small legs up here, it might fall far enough for the bears to make a scalp. A bear breakout and a follow-through bar. Some bears will sell the close, expecting at least a little bit more down. The market's reversing up from a higher low. Therefore, it might be forming a channel. The lines are not parallel, but that does not matter. A lot of times you'll get other highs and lows, and it takes a lot of bars before it's clearly a channel with fairly parallel lines. Can you buy this bear close? We got 5 consecutive bear bars. Well, it's not great to buy the close, but some bulls will buy it. It's about a 50% pullback. We're testing the breakout point above this high, and they'll bet that big up, big down means trading range more likely than bear trend. A bull trend that's as strong as this rarely ever becomes a bear trend, and therefore this sell-off is probably a bear leg in a trading range. The bulls who do buy would put their stop below the bottom of the bull trend. This is the biggest bear bar of the entire sell-off. Given that the odds are we're not going to fall below the bottom of the bull trend without at least going sideways first, this could be an exhaustive sell climax, a bigger bear bar late in a bear trend, and therefore some bulls will buy the close. Higher probability buy the reversal up, especially if you have a pretty good looking bull bar closing on its high. This is a reasonable buy the close bar. All of these bars are reasonable buy the close bars. And therefore, if there's a sell-off and it does not fall below the bottom of the bull trend, a lot of bulls will buy above a strong bull bar, betting that we'll get back to that high close. That would allow them to get out break even on their first buy, and then with a profit on their second buy. We have a bull breakout above a bear channel and a bull trend. It's a bull flag, and traders will buy a high one pullback from this bull breakout, or they'll buy a double bottom bull flag after this breakout. Triangle, forming higher lows, very strong bull breakout, stronger than the bear reversal. Traders will assume the market will go higher. We have a bull IOI, a bull bar, and an IOI at the apex of a triangle. Bulls will buy above the high of this bull bar on a stop. Because broad channels have deep sell-offs, bears can make money as well as the bulls. Some bears will look at this and say, well, it's not all that strong, and they'll place limit orders to sell at the high and scale in higher. If I see a strong bar like this, I'm not going to sell at that high. I'll wait to see what follows. 6 consecutive bear bars closing below their midpoints. Chances are we're in a trading range. And at this point, we have a smaller triangle within a larger triangle. The bull breakout probably will fail to get very far before coming back to the apex of the triangle. Some bears will sell either at the top of the triangle or 1 or 2 or 3 points higher up, expecting the market to come back down to the breakout point. Bears always pay attention to breakouts and pullbacks. Here we have a very strong bull breakout, but as strong as it was, it came back below the breakout point. What do you think the bears will believe if the market breaks above this high? They believe that even if it goes up higher, just like after this strong breakout, there'll be a pullback below the breakout point. Bears selling at this high will scale in higher, betting that the market will come back below the breakout point. Because the market is going sideways so much and having deep pullbacks, the bulls are less confident that the trend is going to be strong. They therefore tend to buy pullbacks and not breakouts to new high. Although here, clearly bulls bought. A lot of bulls will not buy that. They only want to buy pullbacks. And then they'll either take profits at the new high or they'll take profits when the market starts to stall. The bears know that the bulls will do that the bulls will take profits at new highs and prefer to buy pullbacks. And the bears, therefore, are not worried about too much buying at the prior high, and they'll sell at the prior high and sell more higher. For example, since there was a very strong breakout here, yet the pullback fell below the breakout point, some bears will place a limit order to sell at this high or at this high or that high, expecting that there'll be a pullback below the breakout point. If they sell here and it goes straight down, they make money. If they sell here and it goes up higher, they'll sell more higher and then get out break even when the market drops below their entry point. So they get out break even on their first sell and with a profit on their higher sell. Scale in higher. I talk about different ways to do that in the videos on scaling in. Some traders do a fixed number of points higher, 2 points, 3 points, 4 points, and some traders sell with a stop on a reversal down. You want your second entry at least the size of a minimum scalp above the first entry. So a minimum scalp in the E-mini is 1 point. You want your second entry at least 1 point higher. The bars here are big, about 5 points tall. Therefore, if you are scaling in, it's better to be scaling in more than 1 point above your first entry. Better to be scaling in 2, 3, 4, or 5 points above your first entry. A lot of traders prefer to scale in on a reversal down as long as that second entry is at least as big as a scalp above the first. They prefer it to be 2 to 3 times bigger than the minimum scalp. We dropped a little bit below this high, and that allowed the bears to get out break even on their first entry and then with a profit on either of their second entries. Some bears will hold part of their position short until either the end of the day or until there's a reasonable buy setup. Here, this is not a particularly good buy setup, but we're getting a lot of tails below bars. We're near this prior low. We might get profit taking into the close, so it's reasonable to get out on a reversal up. Traders are always trying to decide if there's a 60% probability of the next bar or next few bars going up or going down. We have a wedge bottom and then a rally. A lot of the bulls will buy closes, including even this close, betting that the first reversal down will be minor and lead either to a trading range or to a bull flag. We have a big outside up bar and a small wedge. Reasonable to buy above the high of that bar, or here we have a second entry buy, also a good looking buy signal bar, reasonable to buy above its high. 60% chance we'll go at least high enough up for a small profit. Higher probability, you wait until there are consecutive strong bull bars, and traders will either buy at the market right before the close of the bar, or they'll buy at the close of the bar. When I talk about buy the close, I'm talking about as soon as the market closes, you hit buy the market and you get filled at the open of the next bar, or a second or so before the bar closes, you hit buy the market and you get filled right around the close of this bar. Traders buying up here have a higher probability of a profit at a minimum based upon a measured move from the open of the first bar to the close of the final bar of the breakout, which would be up here. However, whenever you get higher probability, usually the stop is further away, so your risk is greater. One of the characteristics of a broad bull channel is that the follow-through is often bad when a market breaks out to a new high, and that's in part because bulls will take profits. They prefer to buy pullbacks and not breakouts to new highs, and bears start to short. We have a bull breakout and follow-through. This is a breakout bar of this bull flag, and this is a follow-through bar. This is also a breakout bar above this high, and then this is the follow-through bar. Terrible follow-through for the bulls. As I said, strong consecutive bull bars probably will get at least a 60% chance of a measured move up, but this follow-through is terrible, and it creates big up, big down. It increases the likelihood that the market will go sideways for a while instead of straight up. A lot of the bulls will take profits on the reversal down. Small leg one, pullback leg two, big leg one, pullback leg two, and you can even argue a parabolic wedge. One, pullback, two, pause, and three, pause. And then you get a bear doji bar, a small bear reversal bar. Some bulls will take partial profits there, or once they see 3 or 4 consecutive bear bars, they'll exit on the close of that third or fourth bear bar. The bears know the bulls are getting out, and therefore the bears will sell, knowing that the bulls just get out, and they'll be less willing to buy a bar or two later. And the bears were able to make a scalp down. We have 5 consecutive bear bars closing below their midpoints, near their lows. The market's always in short for many traders. However, it's still a higher low above the bottom of the bull trend. This is more likely a bear leg in what would become a trading range. Big up, big down, big confusion usually means sideways. Traders do not want to be selling too low in what they think is going to be a trading range. Again, did not hit the stop below the bottom of the bull trend. It's a higher low, a bull bar closing on its high. You have buy the close bulls from here who were disappointed but never had an opportunity to get out. Once they were disappointed by this bar or this bar, the market never went back to that close. Usually these bulls will buy more above a bull bar, betting that the market will come back to that close and allow them to get out. If you do something reasonable and you manage it reasonably, usually you can avoid a loss and make a profit. Bulls buying here, disappointed by this, buy more above a bull bar here, betting that it will come back up here to let them out break even on their first entry and with a profit on their lower entry. The bears know that, and if they did sell this third consecutive bear bar's close and they did not take profits down here, they will get out above that bull bar. And bulls buy with the stop. Even if a bull did not buy this close and hold long for all of this, any bull who bought for any reason here, did not buy at all, if they're flat, they know the odds are, if you get this bull bar, buy the close bulls from up here are going to buy, and other bulls will buy as well, expecting the market to get back to that close because it was reasonable to buy that close, and after you were disappointed, you never had a chance to get out. So this is a good buy for the bulls and a good place for bears to buy back their shorts. Bull breakout, bad follow through. Bull breakout, bad follow through. Two legs sideways, we have big up, big down, big confusion. You'd expect a trading range. Trading range has a lot of two-legged moves. Here we have leg one, pullback. Leg two, slightly lower high, but still a second leg up. It's subdivided into leg one, pullback, leg two. It even subdivided further into one, pullback two, one, pullback two. Potential double top. We have two legs up in what is probably a trading range. Bulls will take profits on a stop on a reversal down below that bear bar, and bears will sell for a scalp. Very strong bull leg, stronger than the bear leg. Most traders will assume the market's still always in long, and therefore they believe it's more likely to go higher than to reverse down. Market went sideways. Now it's in a small triangle within a bigger triangle after a strong rally. Odds are an attempt at a second leg up. Low 1 and then low 2, and the low 2 subdivided into low 1, low 2. And it's a triangle, but probably always in long. This is a small triangle within a bigger triangle after a strong bull breakout. On a reversal up, higher low, traders see it is sideways forming higher lows, triangle. The bears will buy back shorts and the bulls will buy again, especially above a bull bar, and especially if there's a second entry buy. Here, there's a first entry buy above this bear bar or above this bull doji, and then a better looking bull bar here for a second entry buy. Strong breakout, and again, bad follow through. Wedge, 3 pushes up, 1 pullback, 2 pullback, 3. We may go higher, but this is possibly a wedge top. A breakout of a triangle, late in a bull trend. Usually the triangle becomes the final bull flag. The breakout goes up 3, 4, or 5 bars, usually reverses down back to the apex of the triangle. And there's a small triangle here, so breakout mode, and we're getting a bear breakout. Bulls will exit long on the breakout below the triangle or on the close of this strong bear bar, and bears will sell, expecting a test down to the apex of the triangle. If the bears did not take partial profits there, they could have held for a swing until the end of the day. Higher probability, instead of selling up here, we have a bear breakout and a follow-through bar. Strong enough sell-off, probably we'll get a second leg down, maybe a measured move based upon the height of this upper trading range. So high probability short, or at least a small second leg down. In broad bull channels, it's a channel because you have a lot of reversals, but the odds are, since the market's in a bull trend, most of the reversal attempts will fail, even if they look pretty good. It's always good to diagnose any pattern early because it allows you to enter early. Often your stop is closer, so your risk is less, and there's much more profit potential. In a broad bear channel, the bulls sell above prior highs to take profits, and the bears sell above prior highs, looking for at least a scalp back down. Also, because it's a channel, you have to assume that breakouts to new highs are going to have bad follow-through, bear bars after a breakout to new high. It's a sign of bulls taking profits and bears selling for a scalp down. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on trading broad bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trading broad bull channels. Every bull trend needs a series of major higher highs and lows. The major higher lows are very important. A broad channel is very similar to a trading range, and it has a lot of trading range price action in it. Like in a trading range, the market often has a second leg trap, a strong second leg that looks like it's about to break out, but it traps traders into a breakout trade, and then it reverses. Because a broad bull channel is basically a trading range that's sloped somewhat up, bears will often sell new highs and scale in higher. Likewise, the bulls sell at new highs as well, they sell to take profits. A lot of traders do not like to take a lot of trades. They don't like to get in and then get out and then get in again and get out again. And they're afraid that they'll sometimes miss a big swing trade. For example, let's say a bull bought this reversal. You can call it a wedge bottom, small wedge bottom with a decent bull bar and a lot of good bull bars here. Now we have 5 consecutive bear bars closing near their lows with decent sized bodies. However, it's still above the bottom of the bull leg. Should bulls get out? Well, some bulls will simply rely on their stop. And as long as their stop does not get hit, and as long as the market does not clearly become bearish, they'll hold long, despite 5 bear bars closing on their lows like that. A lot of traders will look at this and say, yeah, it's a pretty big reversal down, but we did not have even a micro double top up here, and therefore the bulls who bought the close here should be able to get out, break even. The market should get back up to that close. And therefore, even though we have 7 bars down, 5 good bear bars, it did not fall below the bottom of the bull trend, and we might get a higher low. We have a reversal up here, which is good for the bulls. Suppose a trader bought here and he was willing to sit through pullbacks like that. At some point, he has to get out. For example, if he did not get out up here, now late in the day, he has a bear breakout and follow through. The market's clearly bearish and unlikely to go back up. Probably will go a little bit more down. Not much time left to the day. He will get out. He gave up a lot of his profit. He bought here, he sold here. He had more profit had he exited there. But some traders do not like to keep getting out and buying again, because a lot of times if they get out, the buy setups never look good enough and they never get back in. If a person is going to hold long and use a swing stop, he'll trail his stop up below every major higher low. A major higher low is a higher low that has a strong reversal up, usually to a new high, but not necessarily. And the bulls at that point, once he sees this or this, will decide that he no longer needs to keep a stop down here. He can put a stop here. And then after he sees a strong breakout here to a new high, he'll trail his stop up from there to below here or below here. Strong breakout to a new high, bulls will trail their stops. I would use my stop either at the bottom of this bull breakout or the bottom of the bull leg. Sometimes it'll drop below the bull breakout, but not below the bull leg. Either one of these two places is a reasonable location for a stop. Strong breakout above a bear channel. Pretty good bull bars here, here, and here. At this point, a lot of traders will raise their stop to below this low. They'll consider it a major higher low. If they're right that it's a bull trend, it should not fall below the major higher low. On the other hand, if it does fall below that major higher low, then it's probably no longer a bull trend. It then probably is a trading range and possibly even a bear trend, in which case they don't want to be holding long. Another strong breakout. By the close of this bar, we have 2 good-sized bull bars and a new high. Traders will trail their stop to below the bottom of the breakout or below the bottom of this swing up, or possibly down here. Again, as long as the market's making major higher lows, then it's still in a bull trend. Most traders are not going to let their stops get hit. Stops are to protect against catastrophe. And if a trader thinks that the premise is no longer valid, or if they think there's a reasonable opposite signal, they'll get out before their stop gets hit. For example, some traders will look at this and say it's a triangle, it's a big buy climax late in a bull trend. The triangle is probably a final bull flag. Maybe get out below a bear bar, expecting at least a couple legs down, maybe an endless channel, and possibly even a bear breakout. Reasonable to get out up here. Remember, a broad channel is basically a trading range. It's always reasonable to get out of a long near the top of a trading range. When you're in a broad bull channel and you're fairly high up, it's reasonable to get out as well, especially when it's getting late in the day. Now, would some bull buy here? Of course. The reversal down below a major higher low here or here means that the market's no longer in a bull trend, that it's either in a bear trend or a trading range. And if it's in a trading range, it's reasonable to buy a breakout below any support because most breakouts fail. A bull scalper might buy there, betting on at least a bounce. Would I take that buy? No, if anything, I would sell. We're attempting to get a bull flag. Instead, we have a bear breakout and follow through. Both bear bars have good size. One closing on its low, the other closing below its midpoint. The odds are we'll get at least a second leg down. It makes more sense to look to sell here or sell below the pullback bar for a second leg down. Strong bull breakout, a series of bull bars closing on their highs, very little overlap. The open of this bar is above the close of that bar, and the open of this bar is slightly above the close of that bar. The bulls are so eager to buy, as soon as the bar closes, a lot of them hit buy the market, and they get filled on the open of the next bar. Many bull bars here, so good buying pressure here leading up to this breakout. The market's clearly always in long, probably by the close of this bar. Whenever traders see a very deep pullback after a strong bull breakout, they think that the market is probably in a trading range. It might be in a bear channel. We might be getting a series of lower highs, lower lows. It might be in a bull channel, higher highs and higher lows. In general, when you have big up, big down, you have big confusion, and traders tend to buy low, sell high, and scalp. Chances are, big up, big down, you're going to go sideways, at least for 10 bars or more. Because the trading range is likely, bulls will look to buy a reversal up. They'll buy here. Here we now have a triangle, small triangle here inside of a bigger triangle. We're still probably always in long, so bulls will buy betting on at least one more leg up. We're still in a bull trend. We're still forming higher lows and higher highs, especially the higher lows, and therefore it's always reasonable to take the buy signals. And some traders will only take the buy signals as long as it's in a bull channel, making higher lows. And that's reasonable. Let's say you bought above the high of this bar, and then you filled right here. Your initial stop is here, but your actual risk was only here. You buy above the high of this bar, get filled here, the market traded down here, and then reversed up. At this point, you know that the most you had to risk was one tick below the low of this bar. So that is your actual risk. You can always exit at 2 times actual risk and have a positive trader's equation. So it's reasonable to exit here. However, when you have a pretty strong reversal up and the context is good for a swing up, it's usually better not to exit, or at least not to exit all. Minimum scalp size in the E-mini is 1 point. Theoretically, you could exit at 1 point if you wanted to, or 1 times your actual risk, which is right here. Probability is high that we're going up. However, when there's a likelihood that we're going to get a swing up, exiting with the minimum is usually not the best choice. Because it's still possibly a trading range, maybe a 2-legged move up, 1 pullback 2, it's reasonable to exit on a reversal down. Especially after we see this, we know the odds are we're going to have a lot of trading range price action, and therefore it's always reasonable to take profits on a reversal down. For example, you could take profits here, you could take profits here, a bear bar and a new high. We have a double top and a bear bar. I mentioned earlier that it was reasonable for bulls to buy this breakout. It's even reasonable to buy closes, including this close. The bulls at this point with this bear bar are disappointed, and a lot of them now have decided that instead of a bull trend, maybe it's a trading range. However, they'll still bet that the market will not fall below the low, and they'll look to add on. A lot of them will buy more above a bull bar as long as the second entry is at least 2 or 3 times the size of a scalp below the first. They buy here. They know the odds are high that we'll get back up here. If you take a reasonable buy, this is a reasonable buy at the close. If you take a reasonable buy and you're willing to scale in and use an appropriate stop, the odds are high, maybe 80%, that you'll be able to either make a profit or at least avoid a loss. And you can see what happened when we get up to the high close. We found sellers. Who sold? Well, the bulls who bought here are happy to be able to get out without a loss. Some of them bought more here, and they're taking profits up there. And then you have other bulls who got out up here, and they bought above here, betting that we would get back up there. The bears know the bulls are doing that, and the bears will sell there as well, knowing that the bulls are selling, and that the bears could make a scalp. Second leg traps are common in trading ranges, and broad channels are basically trading ranges that are sloped up or down. Therefore, second leg traps are common in bull channels as well. We have a broad bull channel. Again, it's similar to a trading range that's simply sloped up. And like a trading range, you often have a very strong second leg that fails to lead to a bull trend and instead reverses and traps traders into buying high. Strong second leg up. So we have leg one, pull back into a triangle, and then a strong second leg up. A lot of traders are hoping that this is going to have a second leg up as well. So breakout, they want a second leg up. However, because the market looks like it's in a broad bull channel, you have to be careful getting excited when you see a strong second leg up, because very often, instead of a successful breakout, you get a reversal. A strong breakout makes traders believe that the market is starting a trend. We have a triangle here, we have a trading range here. A lot of traders will look at this and say, okay, we'll get a pullback and then we'll channel up and go up much further, maybe for a measured move based upon the size of this breakout. However, whenever the market has a lot of trading range price action or is in a broad channel and you see a strong breakout, you have to be concerned that it might be a second leg trap, trapping traders into buying high when the market is about to reverse. This is a buy the close rally, especially right here, 2 consecutive big bull bars. You can buy the close, you can buy the close. As far as buying that close with that big tail on top, I would not. This might be a small second leg up from this breakout, and then a small bar for a pause, and then a second leg up, and now we have a big tail. Can a bull buy that close? Sure. He'll be disappointed by this bar, and if he is, a lot of the bulls will try to get out break even. They'll place a limit order to get out at that close. And look what happened here. The market got right to the close. The bulls did not get filled. It turned down. A lot of the bulls will lower their limit order to a tick or two lower, and that resulted in this lower high. The bulls selling. The bulls who bought that close could not get out here. They lowered their limit order, and we got a slightly lower high. That often leads to a swing down. When you see the buy the close bulls desperate to get out, and they're having to lower their exit price to take a small loss. Buy climax, a little bit of a parabolic buy climax. 1, pullback, 2, pause, 3. And we have a bad bar afterwards and a possible broad bull channel. Rally, sell off, rally, possibly sell off. The bulls could not get out break even, and then at some point they give up here, and then the final bulls gave up here. This is about 8 or 9 days in a bull trend. It's a broad bull channel, 5-minute chart. You can get second leg traps up or down. Here we reverse down, and now we reverse down even stronger. And this low is below that low, below the low of the past 200 or 300 bars. The bears are hoping it's going to be the start of a bear trend. A lot of traders will sell there only to get trapped, because if the market's in a broad bull channel or in a trading range, second leg traps are common. You get a strong second leg, tricking traders into believing it's the start of a trend, but instead it reverses. You get a failed breakout. This breakout is strong enough to get a small second leg down, 60% chance it'll have at least a small second leg down. It's possible that this small higher low is that second leg down. And it quickly became always in long again with this reversal. it reversed this sell-off. We sold off, we tried to get a bear flag, and then we got a bull breakout above the bear flag, almost totally reversing the sell-off. So it's always in long. You got to be thinking that maybe it would lead to a measured move up, and that's the measured move projection. Traders always pay attention to how far a breakout goes above a breakout point. The market broke out above here. This is the breakout point. And traders pay attention to how far this is above that. We have another high. The market broke out and then pulled back. Traders pay attention to how far this is above that. The market tends to do similar things, and breakouts tend to be similar. So subsequent breakouts might break out for about the same distance. We have a breakout point, and here's the breakout. When we reverse down, this then becomes a breakout point for this breakout. This high is 10 ticks above that high. And you can look at the size of the breakouts through the entire channel. We have a very big breakout here, 37 ticks, and you can see the sizes of the other breakouts. Bears sell in broad bear channels. They don't have to. You always want to be buying whenever the market's in a broad bull channel because it's a bull trend. But the pullbacks are deep enough so bears will sell. And part of their selling is based upon the size of those breakouts that I just discussed. Bears need to see gaps closing before they start selling. If they're selling above a high, they want to make sure that the market comes back below the high. For example, if you sell at this high, it did not come back below this high, and it would be very difficult to make money unless you scaled in and then got out quickly enough. Before the bears start to sell, do bears want to be selling highs when the market's doing this? Very difficult to make money in a very tight bull channel like that. The bears need deep pullbacks, and they need pullbacks that fall below breakout points. Once they start to see that, then they'll start selling at new highs, or at least some bears will sell at new highs. We have a very strong reversal up from a break below the bottom of the trading range, and we sold off from a new high. But although you cannot see on this chart, this low never fell below that high. There's actually a gap between the low of that bar and this line, which is at that high. Therefore, you're going to be thinking about a possible measuring gap, a measured move up. The bears tried to reverse down from a double top lower high major trend reversal. The bulls bought again, forming a double bottom bull flag. And again, the gap stayed open. Probably if the market's going to rally for some kind of a measured move, this is probably a measuring gap. It's clearly an important price. We broke fast above it, and we tested it twice and reversed up twice. This is obviously an important price. And now we know this is an important price. The market tested it twice, reversed up without falling below it. And therefore, those two prices will probably create a third important price. If the market is pulling back below breakout points, it's a stairs pattern, and traders pay attention to the size of breakouts to determine where to put stops and where to scale in if they're looking at shorting in a bull trend. We have a breakout here and a pullback below the breakout. And therefore, if a bear sold that high and sold more higher, or simply sold above that breakout point, we now know the bears can make money by selling above breakout points. And once the bears see that, bears are willing to sell above breakout points. Only experienced traders can do that because sometimes you get this. If you sold at this high, the market went up quite a bit and never got back below that high. So you have to be able to manage your trade. And some bears would sell this high, a couple legs up, they'd sell more here, and then either get out at their midpoint, which the market allowed them to do, or they would try to get out at their original entry, break even at their original buy right here at that high. They would not have been filled. And if they were able to get out, they'd have a profit on their higher entry and break even on their second. After the market twice tried to do that, the scale-in bulls who sold more here got out. They got a small loss on their first sell. They sold here and they got out here. and they got a bigger profit on their second sell. So basically break even, maybe a little bit of profit, but only skilled traders can do that. And because this sometimes happens when you sell at prior highs, only skilled traders should be selling at prior highs in a bull trend. And they'll only do it if the pullbacks are falling below breakout points. Why would we get a pullback? Well, the trend has deep pullbacks, so it's not all that strong. Bulls prefer to buy pullbacks instead of buying at new highs, and they tend to use new highs to take profits. They don't necessarily get out exactly at the new high, but if the market starts to stall above a prior high, they'll start to take profits, and that results in another pullback. And the bulls buy the pullback, and they'll sell again at new highs to take profits. The bears know the bulls are doing that. They can see the reversals down, and they can see the bulls buying well below the high. And therefore, bears sell at new highs, scale in higher, betting that we'll get a pullback deep enough to allow the bears to make at least a scalp. Traders are constantly drawing lines, especially when there's a broad channel or a trading range. They're looking for support and resistance. And you keep drawing new lines. Every time you get a reversal, you get a new line. You got lines across the highs. You got a new high, so it creates a new line. You got lines below the lows. The ones below are support. The ones above are resistance. And you want to see what the market does when it gets near a line. Will it break strongly beyond the line, or will it reverse? Usually it reverses because the lines create channels, and the market tends to reverse near the top and near the bottom of a channel. When we're in a broad bull channel like this, 75% of the breakout attempts at the top and the bottom of the channel will fail. And therefore, traders look to enter on reversals, look to buy reversals up from the bottom and sell reversals down from the top. We have a trend line, traders sell the reversal down. 2 points, 2 reversals down, we can create a trend line, traders sell the reversal down. We have 2 points here, sell the reversal down, sell the reversal down, all the way up. And bulls will do the opposite. They draw lines along the bottom, and anytime the market falls below a line, they buy the reversal up, betting that the bear breakout will fail. If you're selling at a prior high in a bull trend, you have to be able to manage your trade well. This is an advanced technique. This is not something that beginners should be doing. But advanced traders can do it if they can manage their trades properly. And by manage the trades, I mean use an appropriately wide stop and scale in. By scaling in, they increase their profit. They also increase their risk. Where is an appropriate stop? Well, you have to use a wide stop, and one way to do it is use one based upon a measured move. The bears have a double top here, where this high is slightly higher. If we get a bull breakout above the double top, the market may go up for a measured move. Therefore, a trader selling needs to put a stop slightly above that measured move projection. He knows that the bulls who buy above the double top are going to take profits around the measured move up, and therefore, if a bear sells and looks to sell more higher, he needs a stop beyond that level where the bulls will sell to take profits. If you are selling at or above prior highs, you need to go for at least a minimum scalp. And in the E-mini, the minimum scalp size is 1 point. If the bars are big and the range is big, you want to go for more than 1 point. Also, you want to go for a reward that is at least 1 to 2 times your actual risk. If you have a particularly strong setup, and the probability therefore is high, 60% or more, then you could exit with 1 times actual risk. If you have an unremarkable sell setup, then you should be going for at least 2 times your actual risk. Also, on any trade, you always have to be going for at least 1 times the size of a minimum scalp. In other words, never go for a profit of less than 1 point when scalping in the E-mini. The bears who sold at that high made money. The bears who sold at this high had to sit through a drawdown, but ultimately they made money. We have another potential double top. The bears who sell this high might put a stop right above the measured move. We have another potential double top, and here's the neckline. The bears want a break below the neckline and a measured move down, but sometimes instead of a bear breakout, it starts to turn down, but then it goes up, and if it does, it might go up for a measured move. And therefore, if a trader were willing to sell at the prior high, hoping for the double top, but instead the market goes higher, they should have a protector stop beyond a measured move up. And again, only experienced traders should do this. You can use tighter stops if the sell setup is strong enough, if the bars are strong enough, if you have good sell signal bars and a micro double top, you could put a stop just above the high of the sell signal bar. Another attempt at a double top, bears will sell at that high, willing to scale in higher, and use maybe a measured move up. Here's the neckline of the double top, measured move up is up here. Same thing here, another sell and a new high. Bears, how do they take profits? They have many different choices. They could exit at a fixed number of ticks, like 4 points or 16 ticks, or if the range is small, maybe 1 point, 4 ticks. Or they can exit with a limit order, maybe halfway down from the most recent rally up. Or they could try to get out below a minor higher low. Or they could simply hold until there's a reasonable buy setup, like a reversal up from the bottom of a bull trend line. For example, a bear selling here, and if he held through this, he might get out at this low. Neckline of a double top, betting the bear breakout would fail, and we get a big high 2 buy, 2 legs down, 1, pullback, 2, and then a resumption up. We did get a high 2 buy, but it fell much further than what traders thought was likely. Again, you can sell and hold until you got 2 legs down and then buy on a reversal up. For example, you could buy back your short down here. Here's an example of traders selling at a prior high. You cannot see it, but there's a micro double top. Once the market starts to turn down, a lot of traders will put their stop above the high, especially if it was a strong sell signal bar. If you're selling in a bull trend, you have to have a plan to get out if the market goes against you, especially if it goes against you quickly and far. Again, I mentioned before that traders look at the size of prior breakouts. One option is you look at the biggest prior breakout and put a stop just beyond twice as big as that breakout. This high went 10 ticks above this high went 17 ticks above that. A trader might put a stop more than 17 ticks above here. He may go twice as much, like 34 ticks above there. 35, 36 ticks. Minimum scalp in the E-mini is 4 ticks. Minimum reward is always 1 to 2 times the actual risk, but it has to be at least bigger than a minimum scalp of 1 point. These legs are big. Some of them are 10 points or more, and scalping for 1 point is probably not the best choice. Going for the minimum in life for anything is rarely ever the best choice. When the channel is 10 points from top to bottom, going for a 1 or a 2 point scalp is probably a bad decision. There's much more profit potential. For example, you could double your profit. So if you were thinking that 1 times actual risk is 1 point and 2 times is 2 points, and it's not very big compared to the size of the prior pullbacks, double it. Go for 4 points profit, 5 points profit. You could also exit around a 50% pullback from the most recent bull leg. Bull leg, 50% pullback. If you sold up here, that would be a reasonable place to take profits because the bulls like to buy 50% pullbacks, and you can see that's what happened. The bulls bought. Some traders will hold for a swing down, taking a chance that we have a successful double top. It would be a double top major trend reversal. Bull trend, bear breakout, double top. It's actually an expanding triangle in here as well. 1, 2, 3, 4, 5. So they might hold for 2 legs down and possibly a bear trend. However, once it broke below the bottom of a trading range lasting that many bars, a couple hundred bars, and started to reverse up, a lot of traders would buy back their shorts, afraid that it's a second leg trap, 1 pullback 2 in a trading range or in a broad bull channel. No strategy is perfect. You're going to lose on some trades. And let's say you've been scalping at prior highs all day long and you decide to sell here as well. In general, I think that's not a good idea. We just had a failed breakout below the bottom of the range and a strong reversal up, so I would not take that sell. But let's say you did sell at that high, betting on maybe a possible expanding triangle. Maybe we'll turn down here or soon, like here. Different ways to draw the expanding triangle. This is another way to draw it. Let's say a trader was using a wide stop based upon a measured move up from the bottom to the top of the trading range, up here, and put the stop a little bit above. His stop did not get hit. However, he's clearly going to be disappointed by the rally that continued after his sell, and he probably would try to get out break even. Experienced traders would also sell more, scaling in, trying to get a profit on their second entry and break even on their first. Yet, as I said, twice the market tried to get below the breakout point and it failed both times. Therefore, this is a double bottom breakout test. The reversal up here is probably going up for some kind of a measured move. And the bears who did sell here, whether or not they scaled in higher, are going to get out above this bar and they'll end up with a loss on this sell. And bulls will buy because it's a double bottom bull flag and a breakout test of the top of the trading range with no overlap. Experienced traders often scale into trades. Sometimes they scale in to make a profit. Other times they scale in simply to avoid a loss. Some of the traders who see this strong reversal up and strong breakout after taking this short are going to be scaling in to avoid a loss. So they sell more higher. This higher short is not to make a profit for some of them. Some of them is simply to avoid a loss on the trade, and they want to get out at the average entry price. If you are willing to scale in, you have to make sure that whatever number of entries you take will not result in a loss bigger than what you're comfortable taking. So you always have to trade small enough so that if your stop is hit, the loss is no bigger than on any other trade. The reason traders scale in is to increase their probability of making money, but that always reduces the risk-reward ratio. It usually results in significantly increased risk. Only experienced traders should ever consider doing it. Some traders will scale in at a fixed number of points, maybe 5 points higher. Others will sell more at a new high, like above this high right there. Some will sell halfway up to their stop. Others will wait to sell a reversal back down. That's the way I think most traders should do it if they're scaling in. They take their original entry and then wait for a reversal down and make sure that the second entry is at least 2 to 3 times bigger than a scalp. The scale-in bulls who sold here and then added at any one of these other places, once they see the double bottom failing to get below their first entry price, will get out on the reversal up. They'll have a small loss on the first entry and a slightly bigger profit on their second entry, basically break even on the entire trade. They ended up scaling in to avoid a loss. They wanted to make a profit. They could not make a profit but they were able to avoid a loss. I have a close-up of this on the next slide. This is the last slide. I put it down as a thumbnail. I want to show the close-up of it right here. This purple box is this purple box, and this is that breakout point, this red line right here. And you can see the market got very close to the breakout point twice, but it never got down to the breakout point. So the bears who sold at that high, they placed a limit order to sell at this high, they got filled right here. This is where they got filled. The market never came back below their entry price, and they therefore were never able to get out break even on their first entry. As I said, some of the bears will scale in more, especially below a bear bar closing near its low. This is a reasonable place to scale in. Not a good sell signal bar, not a good sell signal bar. This is a better sell signal bar. Again, the traders are only doing this if they're relying on their stop. Also, they're willing to hold overnight for a lot of bars. Most traders would not do this, but some experienced traders would. Traders have a micro double bottom here and a gap between this pullback and the breakout point. They'll get out above the bull bar on the micro double bottom. Others will hold, hoping to get a second leg down after the gap down and strong bear bars. And they'll get out here, another second reversal up, or here, a big high 2 buy. Again, a breakout test of the breakout point, never getting below it, plus the end of the day. If they sell more here, compared to here, they have a profit on this entry for any of these exits that's bigger than the loss. Some base the sell size when selling above a prior high. They base the sell size on the size of the prior breakout. This breakout is 10 ticks above that. This high is 17 ticks above that. This one's 8 ticks above that. So they might sell 8 ticks above here and maybe more 8 ticks higher. Again, stop probably has to be a measured move up because the bulls have a double bottom and we could go all the way up to their measured move target before pulling back. Why would a trader sell here instead of here? Because the reversal up is so strong. He might think the breakout might be bigger than 8 ticks, might be bigger than 10 ticks, and therefore you don't want to sell exactly at that high. You want to sell at least as big as the smallest prior breakout, so at least 8 ticks above this high. If a trader is disappointed by the size and strength of the breakout, he can then place an order to get out break even, and he would have been able to get out without a loss on the open of the next day. If he scaled in more, he'd have a profit on his second entry, and he'd get out break even on his first. Again, if he was still short, he'd have to get out on the double bottom bull flag, especially since neither low fell below the breakout point. That is a sign of strong bulls. We have an open gap after a strong breakout. The odds are the market's going higher. You always have to have a plan to take profits, and the bulls like to take profits at or above the prior high. Some bulls take their profits based upon the size of prior breakouts. So instead of exiting exactly at the prior high, they'll look at how big the prior high is above the high before it, and then they'll look for a similar result this time. A 10-tick breakout, 17-tick breakout, 8-tick breakout. If a bull bought this reversal up, he might get out at this high, but he also might get out instead at 8 ticks above it, maybe even 17 ticks above it, given how strong the reversal up is. Once the market has this strong reversal up, it's more likely that the market is either back into a bull trend or simply in a trading range. Because the reversal up is strong, he sees how far the prior breakouts went before they reversed. He'll try to take profits around that same number of ticks above this high. For example, taking profits at 8 ticks up, or twice 8 ticks, or around 17 ticks up would make sense. Instead of taking profits exactly at this high, you can bet that the breakout will go further up, just like it went above here, and this went above there by 10 ticks. A bull trend needs higher lows, especially major higher lows. And as long as the market is staying above a major higher low, it's still in a bull trend, even if there are strong sell-offs in the bull trend. Second leg traps are common in trading ranges and in broad channels. A broad bull channel is basically a trading range that's tilted up slightly. Very often, you'll get one leg up, a pullback, and then an even stronger leg up, and traders believe that the market is becoming a very strong bull trend. Much more likely, it's trapping traders into buying high, and then the market will reverse. Bears sometimes sell in broad bull channels. They'll sell at and above prior highs using a wide stop. Some will scale in. Bulls will take profits above prior highs or at prior highs, and a lot of times they'll base the profit-taking location based upon the size of prior breakouts. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on trading broad bull channels. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trading broad bull channels. Whenever the market pulls back from a new high into the middle third or so of the prior bull leg, that is the buy zone. That's where bulls look to buy. And they want to take profits somewhere above the prior high. 50% pullbacks are common. Very often the market pulls back exactly or almost exactly 50% of the last bull leg and then reverses up, so traders should look to buy around a 50% pullback. Every trading range is a bull flag because it's a broad bull channel. The market is probably going higher. So if the market enters a trading range within the channel, traders should expect trend resumption up. Finally, every channel eventually evolves into a big trading range. This is a broad bull channel lasting several days. A fairly tight bull channel, so a strong bull trend, and bulls will look to buy somewhere in the middle third, and that is the buy zone. Lower third, upper third, middle third of the most recent rally, and that is where bulls try to buy. They either buy with limit orders or on a reversal up. Buy a 50% pullback, place a limit order. Once the market starts to come down, you can figure out where the 50% pullback is, and some bulls place a limit order to buy right there. Their risk is below here, their reward is here. The risk and reward are the same size, but the market's in a bull trend, so the probability is higher that we'll get here before a stop is hit down here. Other traders prefer to buy a reversal up, which is a better way to enter if you're a beginner. You place a stop to buy above the high of the prior bar, especially if it has a bull body, and especially if it's a two-legged pullback or a wedge pullback to the middle third of the most recent bull leg. Broad channels spend a lot of time sideways, and at times it's unclear whether the channel has evolved into a trading range or if it's simply still a broad bull channel. Sometimes you get pullbacks that fall below what you think is key support. For example, here's a 50% pullback. The market has a couple legs up and it failed at the high. Is this a lower high major trend reversal in the start of a bear trend? Or is it the start of a bear leg in a trading range? You don't know. Some bulls will rely on a stop below the bottom of the bull trend, and they'll buy. they'll buy with the limit order at the prior low, betting the bear breakout will fail, or they'll buy on a reversal up, again relying on their stop down here. Here's a bull leg. This is the bottom third of that bull leg, and if the market is much more like a trading range than a bull trend, as it is in this rectangle, rather than buying in the middle third of the most recent leg up, a lot of traders will trade it more like a trading range and buy in the bottom third. When it's clearly in a bull trend, traders buy in the middle third, around a 50% pullback. When it's not so clear that it's still in a bull trend and it looks more like a trading range, traders prefer to buy in the bottom third, here or on a reversal up. You can buy with a limit order somewhere around 60 or 70% down. Some traders like to use Fibonacci numbers, but I think it's nonsense. Better to buy with a stop on a reversal up, especially if you're starting out. Higher probability of making money. It's a bull trend, clearly making higher highs and higher lows, and therefore you can buy at any time as long as you use an appropriate stop below the bottom of the most recent major high or low. Strong leg up, major low. Traders can buy at any time and put a stop there. Another strong reversal up to a new high. This then is a major high or low. Traders can buy at any time and put a stop there. You can even buy at a prior high, for example, with the stop order, one tick above this high or one tick above that high, as long as you use the appropriate stop. Even buying at the high is profitable if you use the appropriate stop, and especially if you can scale in lower. Because a broad bull channel behaves so much like a trading range, it's usually better not to be buying high. You want to be buying low, and you want to be selling high, selling to take profits. The stop is obvious. A very strong bull leg up, a major higher low. This is a good location for a stop. Here we have a spike pullback channel. Some bulls will put their stop here. It's probably better here. And we have a breakout to a new high, fairly tight channel. This is a major higher low in an ongoing bull trend, so a reasonable location for a stop. Strong breakout to a new high, major higher low. Because so much of the time it looks like it's in a trading range, and it is in a trading range, rather than buying a breakout to a new high, as you would do in a strong bull trend, in a broad bull channel, it's better to be buying pullbacks. Rather than buying at the new high, it's better to be buying pullbacks from the new high, because bears will be selling at the new high, knowing that the reversals down will be deep enough for them to make a profit. You should take profits at prior highs. That means you should sell at prior highs, or at least take partial profits. Profit-taking zone at or above the most recent high. If the bulls bought this pullback, they're going to try to get out at or around that high. If they bought a pullback here, here's the most recent major lower high. They'll try to get out here. Here's the most recent high. They'll try to get out there. So every prior high is a profit-taking area for bulls who buy the pullbacks. Again, you can buy for any reason, but it's good to be buying in the middle third of the prior bull leg and then taking partial or full profits at or above the prior high. Or you could take profits on a reversal down. Some traders do not want to put a limit order to take profits at the prior high just in case the market keeps going up. Instead, they'll look to take profits on a reversal down from around the prior high. Here, slightly below that high, and we're starting to reverse down. Remember, the bears are going to be doing the same thing. They're going to be selling exactly where the bulls are selling. The bulls are selling to take profits. The bears are selling to make a profit. They're betting that the pullbacks will be deep enough for them to make a scalp. And sometimes the market will become always in short. and they can make more than a scalp. They can have a swing down. A broad bull channel is simply a trading range that's sloped upward, and it behaves like a trading range, and therefore bulls have to expect deep pullbacks. And you need to stop below the most recent major higher low. Again, this maybe is major. We came up to a new high, a few legs up, 1 pullback, 2 pullback, 3, but it's a spike in channel, spike pullback channel, and the market often falls a little bit below the bottom of the channel before reversing up, and therefore a better location if you're looking for a swing is here. A bull who did not get out on the reversal down here, it's better to have their stop down here rather than here. A lot of bulls like to buy around the most recent higher low, major or minor, or they'll buy on a reversal up. This is a type of double bottom. Some computers will see this as a double bottom. Strong rally, pullback, and then we pull back again, but to a higher low, and therefore this is a double bottom. Some computers will even see this as a double bottom, a slightly higher low for the second bottom, but it's still a double bottom after the pullback from this breakout. So this is a double bottom bull flag. This is a double bottom bull flag. In both cases, you're going to look to buy the reversal up. Double bottoms are rarely ever perfect. Double tops are rarely ever perfect also. Remember, the odds are, if you think it's a bull channel, every one of these reversal attempts will fail. And some bulls, therefore, will buy the closes of big bear bars, betting that the follow-through will be disappointing. They basically are treating it like a second leg trap. Leg 1, pullback leg 2, they're betting that the bear breakout simply will trap weak bears into selling low. Remember, bulls are trying to buy pullbacks. They want to buy below the high because they know there'll be a lot of sellers at the high. Other bulls will sell to take profits, and bears will sell to go short. And therefore, if everyone's looking to buy low, there's sometimes a lack of buyers near the top. The result can be a sell vacuum. The bulls do not want to buy too high, so when the market starts to go down, it often can go very fast, and then suddenly the bulls appear. Here we get a gap down, and the bulls did not want to buy here. However, they were very happy to buy this low. And that's what I'm talking about a second leg trap. In the top third, top half, a lot of times the market will fall quickly because the buyers do not want to buy too high. And then when it falls low enough, all of a sudden, the bulls buy aggressively, overwhelm the bears. There are often many choices for a stop. If the choices are reasonable, using any of them is fine. If you use a tighter stop, it's going to get hit more often, but you'll lose less. If you use a wider stop, it will get hit less often and you lose more when it gets hit. However, if you take 10 trades with the tight stop, 10 trades with the wide stop, you'll end up making about the same amount of money. So it's a matter of personal preference. The key is the stops have to be reasonable. If you use a stop that is too tight or too wide, you're going to lose money. A major higher low. So we have a strong bull breakout, a reversal up. This is a major higher low. That is a reasonable location for a stop, just below that low. We have a new low reversing up, slightly higher low after a strong sell-off from a new high. As I said, some traders would look at this as major, others would say this is really major and this is minor. It's an important minor, but it's probably not really a major higher low. Is it reasonable to put a stop here? It probably is. But in general, if you're not getting out on the reversal down, it's probably better to put the stop down here, which is clearly a major higher low. If a trader did buy for any reason and put a stop down here, he'd get stopped out, but we're still forming a higher low on this reversal up. He can always buy again on the reversal up after a stop was hit. "50% pullback, very important location for any trade. We're getting very deep pullbacks, but higher lows and higher highs, so we're in a bull trend, even though it's weak. The bears are in control for a lot of bars. Here, 50, 60, 70 bars, the bears are in control. Here, 30 bars, the bears are in control. But we're still forming higher lows and higher highs, so it's still a bull trend. Because it's a bull trend, by definition, it's probably going to form a new high before it forms a new major low. At a 50% pullback, for the bulls, the reward equals the risk. Strong bull leg, here's the 50% pullback. If a trader at this instant were to buy, he's looking for a test of the high, and his stop is below the low. His reward is equal to the risk, but we're in a bull trend. Therefore, it's more likely he's going to make a profit than it is he's going to lose money. And therefore, bulls will buy with a limit order at a 50% pullback. Stop just below the bottom of the major low. Here, the bulls have two legs up, maybe a trading range. It did not reach his target. However, it's starting to reverse down. A lot of bulls will exit maybe below this bear bar. They would exit because if the market's turning into a trading range and they bought fairly low, they want to sell high, and they'll convert to scalping more and swing trading less. The bears see it as a double top or a slightly lower high major trend reversal. Bull trend, bear breakout, lower high, and they might get a reversal down. A low, a rally. Remember, this is a 50% pullback. Traders bought it here, and they might either buy it here or on a reversal up from a pullback below the 50% line. They can either take profits with a limit order at the prior high or on a reversal down. Here's a bear bar at the end of the session. They could sell out of their longs below that bear bar. Reasonably strong leg up. A lot of traders will place a limit order to buy at a 50% pullback, this green box. Stop down here, profit target up here. Others will buy on a reversal up, slightly higher probability because the market's reversing up from the support of a 50% pullback. Again, they can exit with a limit order, selling out of their longs at the prior high, or on a reversal down below that little reversal bar. That's a second entry sell. We tried to reverse down below this bear bar, and then just 2 bars later, we're trying to reverse down again. And it's either in a broad bull channel or possibly in a trading range. In both cases, it's reasonable to get out of longs on a second reversal down because bears will sell knowing that the probability is higher of making money after a second reversal down in a broad bull channel or in a trading range. Couple weeks of a channel, fairly broad. It looks tight, but in fact, on the 5-minute chart, it's broad. The market was always in short and was in a bear trend day this day, but that bear trend is simply a higher low in a bull channel. "20-day bull channel. It's a very tight channel on the 60-minute chart. The pullbacks are 20 or 30 points. That's tight on a 60-minute chart, but if you're trading it on the 5-minute chart, those pullbacks are big and the channel is broad. Every broad bull channel has trading ranges within them. And you can see the trading ranges are forming higher and higher up. So they're trending trading ranges. The odds of trend resumption up are better than the odds of trend reversal down when you're in a bull trend. Trading range breakout mode. Typically, 50% chance you'll get a reversal down, 50% chance you get a reversal up, 50% chance the first breakout up or down will fail and reverse. However, the trend up is very strong. The odds always slightly favor the trend continuing. So trend resumption up is always slightly more likely than trend reversal down. If you get enough bars in the range, the probability starts to become close to 50-50. Every trading range has both a reasonable buy setup and a reasonable sell setup. The buy setup is usually a double bottom bull flag, and the sell setup is usually some kind of a double top. Remember, every major trend reversal is a type of double top. Sometimes you get a lower high, other times you get a higher high. Here we have an expanding triangle, yet the trend continued up. In fact, it accelerated up. Higher high major trend reversal, which is a double top, type of double top where the second high is higher. Trend continuing up. Here, a double top, neckline, broke below the neckline, but reversed back up. A final flag, a bull breakout that's reversing down. Head and shoulders top, started to break to the downside, but failed and continued back up. Expanding triangle, tried to reverse down, the bulls bought it, and the bull trend continued. Another final flag reversal similar to this. A tight trading range, a breakout, a reversal down. Many of the patterns have 2 or more ways to label them. It doesn't matter. Don't lose sight of the goal. The bears are looking for a top. You want to call this a final flag top, you want to call it a head and shoulders top, doesn't matter. Expanding triangle top, every expanding triangle top is also a higher high major trend reversal. It doesn't matter. The bears are simply looking for a reasonable sell setup. And all of these are reasonable, which means a trader can sell. Most of these shorts either turn into small profits or small losses. Whenever a top fails, the bears are going to give up and they're going to buy back their shorts for a loss, and the bulls will buy as well. The bears who sell for any reason, they're giving up. The bears who sell, they ultimately give up. The bears who sold this top, if they're still holding short, they give up. The bears who sold this top, it breaks above their stop, they give up. The bulls know the bears are going to give up, and therefore the bulls will buy, looking for some kind of a measured move up based upon the height of the top. Every trading range is a bull flag when you're in a broad bull channel. If enough bars form, then the probability gets close to 50-50. But in general, you have to assume that if the market's in a broad bull channel, every one of those trading ranges is more likely to continue up than to reverse down. Here we have 6 trading ranges. Different ways to draw them, but I chose to draw them this way. Every one of the trading ranges is either a bull flag or it contains a bull flag. And a bear breakout below the bull flag is probably going to reverse and the bull trend will probably continue because trends have inertia, which means they tend to resist change, and that means that they tend to continue up. A breakout above a bear channel, and we have a double bottom bull flag within the trading range. If you want, you can call this a triangle, and the bull's got a breakout. A wedge bull flag. We tried to reverse up again here, trying to reverse up again a third time, and that makes it a wedge bull flag. double bottom, another wedge bear channel. Every wedge bear channel is a bull flag when you're in a bull trend. Failed breakout below the bottom of the trading range, maybe? We don't know yet. We don't know what the bars to the right look like. Again, because the market's clearly in a trend, even though it's in breakout mode, the odds are always going to slightly favor the bulls, sometimes greatly favor the bulls if the trading range is brief. As long as it continues to make higher lows and higher highs, it's still in a bull trend. Easier for the bulls to make money than it is for the bears to make money. And that's because it's in a bull trend. It's more likely to go up than down, and bears making money are only making a little bit of money. Some of the bulls who are buying, they're buying down here and they're riding it all the way up, and they have a huge swing profit. The best the bears can get is an occasional brief swing down. A day trader is going to trade each one of these days individually. Here we have a bear trend day in a bigger bull trend, but it's still a bear trend day, and you have to bet it's going to be a bull flag. But if you're a day trader, you're going to be selling because the 5-minute chart during this day is in a bear trend. This is a broad bull channel, and here we have a bull breakout above the bull channel. However, 75% of the time, if you get a breakout above a bull channel, it's going to fail. This is the 25% of the time when it does not. You have a strong breakout above a broad bull channel, you have a pullback, and then you have another channel, and then eventually it falls into a trading range. The market cycle starts over with the strong breakout. So breakout, pullback, channel, and then trading range. The market was trying to reverse repeatedly, and here we broke out strongly, and the character of the market changed from a bull channel, which should have evolved into a trading range, to a new bull breakout, and therefore the market's probably going to get some kind of a measured move up. And it's a breakout again. Normally a bull channel evolves into a trading range. 25% of the time you get a breakout, and you trade it as you would any other breakout. The market cycle is starting over. Every channel eventually evolves into a trading range. Sometimes a very big range, but still a trading range. This is a 120-minute E-mini chart, Globex market. We have a channel here, we have a bigger channel here. Nothing lasts forever. Eventually everything evolves into something else. Channels usually evolve into trading ranges, which means bull channels 75% of the time have a bear breakout and then a bear swing, and the entire chart ends up as a big trading range. Only 25% chance you're going to get a successful bull breakout above a bull channel and then start the market cycle over again. "75% chance a bull breakout above the channel is going to fail, and eventually the market will have a bear channel and usually forms a large trading range." Once the market starts falling below major higher lows, like here, then it's no longer a bull trend. It's either a bear trend or a big trading range. As long as it keeps making major higher lows, it's either a bull trend or a trading range. I began by talking about the buy zone. When the market's in a bull trend, you try to buy a pullback to the middle third of the prior rally, prior leg up. Bulls tend to take profits above the prior high, above the top of the bull trend. and bears will scalp up there. 50% pullbacks are important because if the market retraces 50% of the prior bull leg, a trader buying at that instant has a higher probability of a new high than he does of the market falling below the bottom of the bull leg. Risk and reward are equal, but probability favors the bulls, and therefore buying a 50% pullback in a bull trend has good math. Every trading range in a broad bull trend is a bull flag. The odds are the market will continue higher because the market is in a bull trend, and those trading ranges are just part of the bull trend. Eventually, every channel evolves into a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on trading broad bull channels.